another episode of With Sonar. I am Luke Velasquez bringing you another episode for our new time at 4 p.m. Folks, thank you so much for tuning in. Today we're going to be talking about the state of freight, which should be the title of the show, so don't steal that. Anyways, thank you for joining. There's a lot of volatility. The freight market right now is an absolute roller coaster, so we're going to be showing you a little bit about how to navigate that as best we're able to today. But first, my partner in crime, Kyle, Mr. Miami. How are you doing today?
I'm doing good. We're out of my apartment. So if you follow me on LinkedIn, my live at Kyle's apartment, we are now in the FreightWaves office. So that is, I'm glad to be out. Thank God.
You've been getting some pretty good feedback on the live with Kyle or from Kyle's apartment.
It's not my apartment. It's Kyle's apartment.
Kyle's apartment.
Yeah.
Okay.
So
okay, I got you. Sure. So we're in week 3 now of solitary confinement for the most part, except for when we film right here. Any latest tips and tricks that you have for staying productive at home?
I hit me 4 miles this morning. Went out for a quick run. It was a little cold this morning and got up at 6 o'clock. Again, waking up early, getting the workout out of the way early really helps you out for the whole day. So
yeah. I think I ran about half a mile on Sunday and lost about 8 years of my life.
I think you ran from the car here, and that was the most you've ran probably.
Yeah, I mean, like, no. See, I'm very productive at home. I feel very productive. You don't have the typical distractions of office life, but I also feel like I just sit, and I'm just like, I don't get up. I don't move around.
I don't know what day it is. If it wasn't for coming in on Wednesdays, I wouldn't know what day it is because they just all blend together.
No, absolutely, absolutely. So there's that fun. There's definitely a little bit of fun there. I need to get out and move a little bit more, though. I think what it was is I used to go to the gym, and now all the gyms are closed. I don't really have like weight equipment at my home, so I try to do like burpees, which are awful, and pretty much anything that requires cardio. It's not a thing. I have to go find it again. So that'll take some time. Didn't used to be that hard.
Yeah.
Anyways, good. Well, we're going to be bringing on a guest here in a minute, and he's no stranger to FreightWaves TV. One could say he likes to watch himself on TV. But anyways, give us a warm welcome for the Sultan of Sonar, Zach Strickland himself. Thank you very much for joining us today. You've got 3 people here to clap.
I know. Yeah.
So it's not as. Thank you. 4 or 5.
There it is.
Appreciate you. From the back. Good hell, yes. The Freightonomics people are clapping for us.
The FreightWaves personalities.
Oh yeah. How are you doing?
Good.
Good. Thanks for joining us. Is this your first time on the show?
It is. It's my first time on With Sonar.
On With Sonar.
It's strange.
It is strange.
It's one of the. I think it's literally the only show.
Yeah. The only show that you haven't been on.
I haven't guested on at some point.
Right. Yeah. Save the best for last, of course. So, for folks that don't maybe watch some of the other shows or aren't as familiar, give us a little bit of background on yourself.
Yeah. So I was in transportation for 15 years. Prior to this, spent a lot of my time at an asset-based LTL provider as a data engineer, pricing manager, as well as financial analyst there at the very end. So basically, I worked with a giant Excel spreadsheet for about 15 years before coming on here. And now I specialize in basically translating the data into something actionable, or I help the data team also understand the context of what's going on around that information.
So you're pretty good at Excel is what I got from that.
Really decent.
It shows. It shows a lot.
Moderately okay.
Yeah. By the way, your company that you worked for was one of my customers when I was moving freight.
Nice.
Fun fact. Anyways, so how did you get the name Sultan of Sonar? I don't think I ever learned that.
So back in the early days, before we had Sonar being what it is today, which is a giant amount of information. We were trying to figure out a way to communicate with the rest of the world on what we had in there. Again, my natural tendency is to gravitate towards the information and help relay what it means, how to use it, provide context, etc. So when we had 2 indexes in there, tender volume and tender rejections and a few other things, I was one of the only people that kind of understood how the trucking industry worked with the data. So they said, hey, we want you to run a chat. And
nice.
Craig basically said, we need you to have a nifty name on this chat. And it was, it needed to be something that rhymed, or cutesy or something like that in the chat line. So it basically came Sultan of Sonar because it had 2 S's, and the rest is history.
I like it.
Yeah.
That's pretty good. I didn't realize Craig came up with that.
Yep.
We need to come up. You have Mr. Miami.
Yeah.
I threw that at you. I don't know if you wanted it, but I gave it to you.
It's one of those that I'm not going to complain. It's not the worst, right? But Luke, that's all you
people
got.
just told me to get lost. So.
Get lost, Luke.
Yeah, get lost, Luke. There you go, lost Luke. No, in all seriousness, we're going to be talking a lot about the state of the freight market today. I mean, we're on a roller coaster ride, it seems.
Extreme.
Yeah. Some of the most extremes, some might even say more extreme than 2018 in some cases, maybe less in other cases, but.
So the volatility itself is more extreme than anything I've ever seen. I mean, we're breaking statistical models. I mean, you watch the financial markets hit pause for 15 minutes. That's because literally all those super smart people from like MIT and Harvard that have programmed these algorithms, they don't expect that level of volatility, so it breaks all their predictive models.
Right.
And it breaks all of their stuff. So if they let the market just run, then it'll literally just trade all the way down to 0. So that's why they have to say, stop, you guys reset your algos.
Take a breath.
And that's essentially what we're seeing in freight market volumes as well. So it's not necessarily that we have seen the highest absolute peak in our outbound tender volume index of all time, which again is roughly 2 years old at this point, formed in March of 2018. But the rate of increase is also a record breaker. The amount of, the quickness with which it attained that high level was, exceptional. And then, of course, consequently, the tender rejection rates, which measure, the rate at which carriers reject their electronic tenders, also hit. It didn't hit an all-time high, but the rate at which it moved there for a little while was record-breaking as well.
I think it was at least a 365-day high.
Yeah.
But yeah, I think we were looking and I think the volume levels reached an all-time high. They rose almost 30% in about a 3.5-week period.
Yeah, which is insane. I mean, again, you're talking about volume levels that are 20 to 30% higher than year over year.
Yeah.
Again, everybody's going to be like, well, what does that mean? 2019 was soft. Well, actually, March of 2019 wasn't that different from March of 2018 in terms of overall volume level. The capacity, however, was vastly different. The supply side was very different in 2018. So there's always this hidden aspect in the freight market that it's supply demand, and if the demand is basically represented by the volumes, and the supply is, of course, represented by the amount of trucks available wherever the freight is. And so the outbound tender volume index answers that demand side. The tender rejection index actually answers the end result of the supply demand.
Right.
So we still have a little bit of a blind spot to supply, but we can see the end result. As long as you have 2 variables there, you can kind of guess where the supply side is at any given moment. And the interesting thing about what we're seeing today is the fact that this is a completely demand-driven event in terms of driving volatility. Yeah. So the demand actually, as opposed to the holidays, where you have a supply side contraction because all these drivers go offline, the carriers are trying to, put their 500-mile boundaries around their drivers so they can go home, go to vacation, et cetera. There's a lot of other factors involved around Thanksgiving, Christmas, July 4th, et cetera, other than just volume.
Kyle and I, we've been talking to a lot of folks, and while on the surface, maybe to an outsider, we see the charts going up and to the right for the most part, or at least up until about a week ago on the volume scale. And I guess to an outsider, it might seem that wow, the freight market's doing incredible. Gosh, anybody in the market should be killing it right now, minus the shippers. But that's not what you're hearing, right? A lot of them are pretty scared from the folks I've been talking to. Are you hearing the same thing?
Well, I think if you're in any segment that is being extremely affected by this, I mean, you've talked about it enough, Zach. I mean, if you're not in that consumer goods or in the grocery stores, you're getting hit really hard. And so if you're on the retail segment, I mean, that is taking a shot really. And I'm talking to shippers, I'm talking to 3PLs, I'm talking to carriers. They're all saying the same things. We keep seeing the articles come out, people laying off employees, trying to lower that, that total head count, try to see how long they can keep this capital and stretch it out as long as they can. But yeah, you have a lot of fear. And then you also got people who are, saying they had record months, that they're doing a great job right now. I mean, they're waiting for it to, fall off, but.
I think that's the thing, is that everybody knows, anybody that's involved in any statistical modeling, when you encounter something like this in your stuff, I mean, we have that predictive rate tool.
Right.
Yes.
We actually had to adjust the algorithm there because, just like with the stock markets, it broke the model.
Right.
It didn't technically break it, but there's things built into those models that ignore that level of volatility because they're treated as anomalous.
Right.
And they're not considered valuable in most situations because it's like, oh, this is just a blip. Don't consider that into your calculation. Well, we had to tell it, no, you have to consider this right now. The problem is that there's no real good model for how to account for such a rapid rise.
Yeah.
Because with any rapid rise, there's generally a rapid fall.
Right.
Those sustainable periods of growth, they're generally done over long periods of time, not short.
So if you were putting yourself back into the position of, filling out RFPs, for those shippers that are still moving forward.
Don't bring back the nightmares.
Yeah, I'm getting a twitch over there, right? But because there's still RFPs out there that are being filled, and so how would you would you just say I'm not going to fill out this RFP and just potentially lose out on the business? Do you aim high? I mean,
no. We talked about this a little bit on Freightenomics today. The way that I would approach this is a lot more level-headed. I know, and I talked about it from the shipper, broker, carrier aspect of it, like you're always on one side or the other. This period of time needs to be, if you are putting out a bid at this period of time, number one, you probably shouldn't. Because not only for you, but for the carrier, the environment is going to be so dramatically different here in the next couple of months than what you're putting out now. You have no idea what that environment is going to look like. The chances for rebid this year are higher than ever, especially if you put them out in the early part of the year. I would certainly recommend putting out a mini bid if you're a shipper, just to say, hey, let's get through these next couple of months. And from that aspect, the carrier's not going to probably take too aggressive of a stance with you. Just be like, hey, you don't mess with us now, we'll be back here in a few months, but we know that right now, we can concede that this is going to be a volatile period of time, depending on the commodity that you're shipping, of course. Like you said, the retail side is obviously non-existent, but a lot of that capacity is going to slide into some of these other sectors that need it. Medical supplies, food, as you mentioned, definitely in need right now. So capacity will flow where it needs to go naturally. But if you are a carrier, do not get super excited about right now. I know I used to, but I never saw anything like this either. But I'm taking maybe just a couple of percentage points if I want to. But I think a lot of carriers right now are taking that defensive side because they know this is a very short-lived event.
Right.
They're probably going to pull back a few percentage points and try to bump their position on the route guide a little bit, which I don't think is a bad play. But at the same time, I think the odds of you having to go through some sort of reevaluative period here in the next 3 to 6 months are very high. So it's, I wouldn't go profiteering style and get like 5 to 8%, increases or, get excessive with the rate offering. But I wouldn't take back too much either, because you need to account for the fact that we are in a super volatile period of time. And my advice for most people, especially those with sonar, is right now, you have to look at every single day. Normally, in a normal world, back in February, if you remember February.
Right.
Yeah. It feels like a distant memory.
Yeah, it feels like 2012 to me. You can go like a weekly look, which is a standard cadence of looking at things. But right now, every single day is presenting new information. So you have to take into account any kind of shift in any trends that you see, because right now we've crested that peak of volumes. But they're not all falling all at once.
Right.
We've got Atlanta, we've got Harrisburg. I mean, you're on FreightWaves now with me in the morning. You've seen it. These markets, these huge markets in the country that drive a lot of the capacity, are kind of taking these little stair steps, down. They're not just dropping off a cliff.
Free fall.
No, and that's the way they increase, though. They increase, like, I think Harrisburg's 46% up month over month right now, which is insane.
It's insane for a market of that
and
size.
it's still kind of, it's come down off its peak, but it's still not like all the way down.
Let's go ahead and flash up the chart real quick on my screen so the viewers can see what we're looking at. So this is really high level. The line in blue, those are the volume levels for truckload in the United States. Now this is an overall look. It's got van, it's got reefer, it's got everything lumped in this particular view. So you can see this peak here, right where that white line is. That's March 23rd, where that peak was. And then we've begun falling. Typically, we float around this mark right here, plus or minus a little bit, sometimes a little above, sometimes a little below.
Right.
That's about average, give or take. So we're still, about 15% above that mark, which is quite elevated. And then, so kind of here's one of those stair steps. We had a couple of days here where we kind of hung out for a little bit, and different markets react different. Like you said, Atlanta, Harrisburg, they don't all fall at this rate. They all stair step at their own rate. Now the orange line there, I think that's one that has me peaked. We know the volumes will slide, and we know everything will slide off of this peak, but the orange line is those tender rejections. So the rate that the carriers are turning down their electronic tenders, that's coming down as well. But do you think that will come down back to normal level, whatever normal levels turn out to be in the next few months, or does that still stay elevated?
Yeah, I think this actually fascinates me, this chart exactly that you're talking about here, because if you look at the volumes increasing in the beginning, tender rejections, it took them a minute to respond.
At least a week.
And again, this speaks to the fact that we are in a completely demand-driven event in terms of what's driving rates, which is traditionally what people think of when they're thinking of peak season, is like, oh, the volumes are increasing. Well, that's not actually always true. Right. A lot of this has to do with supply side contraction. March is like the perfect month for carriers in terms of being ready to absorb any kind of capacity surges or volume surges, because nobody's taking vacations. It's one of the least vacation times a year. They've been on, a lot of them have like diminished hours in January, February, and then they come back online in March. We traditionally see a 3 to 4% bump in volumes in March, seasonally speaking, off of February. And so the fact that everybody was basically waiting and they could absorb, roughly almost 10% increase in volume, at least for a short period of time with little disruption. And then all of a sudden, once they get to about 11 to 12% increase in volume, tender rejection rates just go exponential. I mean, we're parabolic at that point.
Right.
And now we're watching, volumes kind of had stopped increasing for a few days. Again, this totally makes sense if you're thinking about carrier networks. If they're out there, struggling to cover, certain markets, this has thrown their networks into complete disarray because they're getting more volume out of Harrisburg, less volume out of, LA. They're designed to be very efficient in where they are moving their trucks. So they want to have equal amounts of trucks going in and out of every market, ideally. That way they can cover all the loads, that they have in their customer base.
Right.
And so tender rejection rates rising for a few more days, basically about 5 to 6 days longer than volumes did, makes sense. But now we're seeing tender rejection rates decline like fast. Like now that we've crossed the peak, capacity is going to get under control a little bit faster.
And I think that's interesting because there's a lot of talk about, well, we had this major rise. Now where's the bottom? Is the bottom just back to the normal levels, or is it below it? Is it maybe even a little bit above it? I think imports have been down. We don't know.
I think everybody's anticipating this huge bottom, which I don't think is wrong. We are definitely tracking cancellations. Void sailings are up, and a lot overseas. Of course, China is not all the way back online. I think there was a thing today that basically said that, the way they reported their recovery was not accurate, which I know was a big shock to most people. Sarcasm. But yeah,
we won't hold it against you.
Yeah, I think one of the charts you're going to show the people is on the customs side, and we have not seen a recovery on the import level yet. And again, not that all of our freight is fueled by China by any means. I think it's roughly 22 to 30% of the overall freight volume in the United States at any given time originates in Asia to some extent. But the fact that our inventory levels were peaked out in January, February due to trade war. Basically, the timing was perfect for everybody. Brought in a bunch of stuff from some stuff.
Words are hard.
Prior to Chinese New Year on January 25th.
Yeah.
So we were ready for all this inventory surge. Now, were we ready for the right inventory? That's another question. Anyway. What we're going to see here in the future is probably, with the unemployment levels going haywire, 3.28 million, eventually that's going to translate down into the demand side. People aren't going to have as much money to spend. The retail sector, of course, is completely shut down. The food stuff is a little bit questionable in terms of people are still going to eat.
Yeah.
And they're just going to shift from restaurants to grocery stores. So that may not have as big of an impact, but the other side of things where businesses are laying off people, shutting down, capital expenditures won't recover like we kind of expected them to earlier in the year. So volumes probably will drop to winter levels or below that to an extent. I am certainly not. I'm not clairvoyant, so I couldn't tell you exactly how far that'll go. But looking at the OTVI chart, it looks like by the end of April. We should be back to the 10,000 baseline that we see, which is still better than we were last year.
Well, isn't this still reliant on whether or not we're going to be going back to work, everything back to normal life? I mean, honestly, like you said, did we bring the right inventory in place? Were we prepared for, retail? I mean, it's already a down, beginning of the year is usually down for retail sector anyways, but, For this, now we're seeing just such a downplay in people spending on the right type of goods.
Yeah, no, but there's still so much freight. Like people, like the thing you have to realize, looking at the OTVI, those volumes are coming down, but they're still higher than they were last year. We're just not seeing the rise that we were.
Yeah.
So we're still seeing more truckload volume in the United States right now, whether that's consumer goods or what, and less automotive, which is true. You look at Sonar and you'll see Detroit volumes are actually down significantly month over month, which is a heavy automotive sector. And some of these areas where you do know that there's more consumer goods, the Procter & Gamble's and some of these bigger consumer product shippers are present in some of these markets. They're definitely going to be, the food producers, of course, definitely going to have a lot more higher volume in those areas.
Right, and it looks like we're seeing that as well because we are live. That's something new with Sonar. We're live now. But
taking comments live.
Yeah, we're taking
got
comments.
Any goodies in the comments?
Oh, I mean, LinkedIn is fired up. One, Dooner wanted to give you a shout on your fly New Balances. So one hashtag retail sector is coming to you live here with New Balance. But everyone's kind of feeling the same thing. It's really spotty. Ben Harrison says a nosedive in the past 48 hours. Looks like Paul from PAS Trucking. It's really market dependent, which makes a whole lot of sense. It's what we're seeing. It's what everyone's talking to us about as well.
And that's an important thing, because if you are a carrier and you're trying to balance your network out, say you had some exposure, in theory, to automotive and some exposure to food. You designed your network based on having a lot of, that seasonal balance of food production coming out of a market, maybe out of Lakeland, Florida, for instance, and going into Detroit, and then a lot of volume coming out of Detroit in August, when automotive is kind of peaking. I guess it's June to August, somewhere in there. And now that is all disrupted, you're going to see dramatically different environment where you're going to see spot market rates surging in areas and dying in other areas. We're going to see that for the next several months, more than likely, as these commodities and industries fluctuate with employment levels and sending people back into the office. I mean, we're shut down through the end of April, which, again, we also need to know how much this stimulus package is going to impact retail. The Americans have a very short memory span, as Anthony Smith likes to talk about. They'll start spending that money as fast as as they can. We're kind of jaded as a society at this point. So
I think you bring up a really good point too, and the OTVI, as those volume levels continue to fall, while they are nosediving, they're still 15% above record highs.
And it's going to take a few weeks, more than likely.
I think it's just we felt this craziness, this absolute surge that we've never felt before. And when we came off of that peak, we were just like, oh, this isn't so bad. But it's like, guys, we're still really high right now.
Yeah.
We are nowhere near
the dude had a solid post the other day on LinkedIn, Mike Vincent, where he said that exactly. We're still higher than last Christmas. We're still higher than the 2018 peak. We're still higher than all of these benchmarks that we're looking at.
And we have to consider that this is driven by a certain sector, like food, beverage, consumer products, et cetera.
A lot of frozen foods being moved right now.
And all those industrial products are down. So it's even more than we even anticipate because it's in one sector versus several.
Right. No, exactly. And so, CM Evans here on LinkedIn brought up, can tender rejection rates be translated into load count for perspective? So someone who doesn't know about Sonar, really is not familiar with our tender rejection rates, how would you kind of simplify that for
you definitely want to look at OTVI. OTRI is a, like I said, it's the answer to the supply-demand equation.
Right.
You definitely want to look at OTVI if you're looking for some sort of proxy for load count. The index has a base value of 10,000 based on March 1st of 2018. So basically we're looking at what, 118? Or no, I want to say we're about 18% higher than we are.
Yeah, we're about 18% above that now.
Yeah.
16%, 18%, somewhere in there.
Somewhere in there, about 18% higher than we were at that point in time. So knowing that, there's a lot of freight moving out there right now regardless.
About roughly a 16% load count increase right now.
Precisely.
What you could say.
Yeah, so
tender rejections are going to show you the rate that contracted loads are being rejected.
And they're very related to spot market rate increases. So if you have we had a 5.3% tender rejection rate in February. Now we're sitting around 17, 18%. Actually, a little over 18% tender rejection rate. Spot rates, of course, have come up.
They'll follow those tender rejections pretty closely.
Yeah, so CM Evans, really it's not to look at the amount of really freight in that market, but to give you the sentiment on how often loads are being trickled out of that route guide. So if you want to learn more, go ahead and shoot us a comment. We can definitely dive in a little bit deeper. But great question.
It's a really good question. I want to draw attention real quick. I know we're getting towards the end of time here, so throw the screen up real quick. This right here is the U.S. Customs import shipments, so coming into the United States from China specifically. So about 20 to 25% of U.S. imports are coming from China, I think is the number, somewhere in there. So it looks like we double bottomed out here in March, and we've bounced up a little bit. So we're still about, I guess you could say about 50% off, about 50-55% off of where they typically are, but we're off the bottom. We're moving up. They're getting back online.
What's interesting is that double bottom is actually present last year as well. Yeah. There's a little bit of a weird anomaly in the way that custom shipments come into the United States after Chinese New Year. So the seasonal drop is actually quite normal, except for the gravity of the seasonal drop. Like you said, I think at the worst case, it's 56% lower than it was this time last year, or versus Chinese New Year. Right. Which is where we really kind of derive a lot of our inventory levels.
Right.
And that's where you said it, and I don't think, and folks that don't look at imports as much or keep as close of a pulse on it don't realize when Chinese New Year rolls around, they shut down. Yep. So there's always a drop around this time, and the fact that it hit right around the same time that they got shut down due to the virus was almost too perfect of timing to make this, I think, this nosedive even worse. Right. So it's coming back online though, so hopefully that will eventually trickle back into getting inventory levels back up. But I guess too, we also have to note if consumers come back online and are actually willing to spend, because if we're not buying, that number's not going to keep going back up.
Right, and there will be some level of replenishment. It's good to see that they're recovering at least somewhat. Like we said, we don't have a lot of visibility into China and how it's recovering. So if anything else, it's a good sign to see that they're actually doing something. But again, in the translation from how things come from China and then translate into truckload volumes, that's another story altogether. Right. As they go in to get transloaded, you can look at rail volumes, et cetera, to to kind of see some of that proxy.
Fantastic, good stuff. Well, I guess the good news is there is some light at the end of the tunnel. Imports are coming up, so we'll wait it out, but this has been a pleasure. Thank you for everybody that tuned in on LinkedIn. We're going to wrap things up here, but if you have any more questions, leave a comment below. You can also, if you want to see sonar in action, you want to just see like a full-on, display of it, one-on-one, there's a little QR code in the bottom right-hand corner. The dude, everybody!
There he is.
Hey!
There he is.
Just in time.
Rock star.
Anyways,
Walking through the camera.
yeah, I mean, listen, that level of confidence that man has is next level. We all aspire to that. Thank you for that. We appreciate everything that you do. Anyway, folks, on that note, have a wonderful rest of your evening.
God.
We will be here live next Wednesday at 4 p.m. Zach, thank you for joining. Be safe, be healthy out there.